This is the Bill Kelly Show on 980 CFPL in London and 900 CHML in Hamilton. I'm Shiona Thompson filling in for Bill. Some Canadians may soon get a little bit of a surprise. They're going to see a cap on their home equity line of credit, at least some of them. This as the federal bank regulator is reinforcing the financial system against loan defaults. It may not be very popular with some banks because that particular type of home equity line of credit has been pretty lucrative. To help us understand more of what this means, James Harrison is joining us. He's a broker with Mortgages.ca. Thanks for your time and expertise, James.
No problem. Thank you for having me.
So this is a particular type of home equity line of credit, correct?
Yeah, I mean, every property can have a home equity line of credit, and you can access up to 80% of the value of the home. But the max home line of credit is actually 65% for a standalone line of credit.
And my understanding is that this is targeting re-advanceable mortgages?
That's correct. The re-advanceable portion above that 65% loan to value is what they're trying to limit, that it continues to increase as you pay off the principal above that 65%. So it's not really going to have a huge impact, and certainly no material impact on the market.
Has this been an area where people have been running up too much debt?
I think that's a concern by OSFI, the regulators, that having so much available access to funds is a fear. But, only 65% of Canadians even have a mortgage. 60% of Canadians have a mortgage. And of those, how many have a line of credit? I'm not sure the stats on that. But most, let's say, maybe less than 1% or even at the 80% mark. So I think this is more of a headliner versus a serious impact on the market as a whole.
Well, it seemed like it was a very particular and potentially a narrow sector of the home equity line of credit market. But it's also apparently, this is the Office of the Superintendent of Financial Institutions. I'm not sure a lot of people even knew there was such a thing. But they're trying to strengthen Canada's banking system. It led me to wonder whether this is a bit like closing that particular barn door after the horse is already out.
Well, I mean, I guess it could be looked like that way at first. It is somewhat of a tightening, but really not that much of one. We don't really want most Canadians to be maxed out on their line of credit anyway. It's not good for their credit. It's not a good position to be in. So I think it's a minor change, but I don't think it'll have a significant impact. It certainly won't have any impact on the problem that we have, which is supply.
Yeah, we've been focusing a lot on supply throughout this show and, many shows as well. One of the things I was looking up, though, was what is the latest household debt ratio? And it's running at about 184.5%. At least that was the first quarter of this year. That is way too high.
Yeah, you mean as far as how much everyone is spending, like 184% of their income? That is scary. To think of, for every dollar you earn, you're spending $1.84. That is concerning. So I think that that is something that they're rightfully concerned about.
Well, you were saying that this may not affect a lot of people because few have this particular type of mortgage. And frankly, it sounds very complicated. I'm not really sure the average person would understand what they're getting into. But it has been somewhat lucrative for banks. Are they happy? What's their reaction to this being tightened up?
I'm sure they have mixed emotions about it because at the end of the day, you never want to impact the profitability of your business. And the home line of credit is a very profitable tool used by those in a professional manner is certainly a good thing, but sometimes it can get out of control. So they want to put a limit on it. Some banks have already sent out letters to those who have a home line with multiple examples, and I've read it because I have home line on every property I have, and it is very confusing to look at it first. When you break it down, it's really not that big of an impact. But so you can still refinance up to 80% of the value. Just you can't have, all of it as a line of credit. And I think that's a good thing. And as you pay off the principal, it's not just automatically going to be re-advanceable to the max.
So the people who were accessing this, I mean, for so long we had, interest rates. The bank rate was incredibly low. It was almost like free money, but not quite, because it never is. Somebody's got to make a buck somewhere. But for the people who took advantage of this, does this put them more on the bubble?
I guess that would be maybe some. I think that the statistics or the numbers are actually a lot smaller than people think, at least from what we're seeing. Those that have a home equity line of credit, you have to qualify at a much higher interest rate to even get one. So I think that, and what we've been seeing, at least with our office, is most are not even close to maxing out their available line of credit anyway. It's more of an annoyance in a way. If you like to have access, now it's going to be limited by a little bit. But I don't think it'll have that big of an impact.
We're speaking with James Harrison, who's a broker with Mortgages.ca. As long as I've got you on the line, we have seen some indicators that the economy may be balancing out, that the Bank of Canada's strategy, and it's actually been the strategy of a number of federal banks around the world, the Fed in the United States and the Bank of England as well, about hiking interest rates, their central bank rate. We are expecting that the Bank of Canada, even though there's been some improvement and a slowing of the economy, but the central bank rate is expected to be hiked by another quarter point at its next setting. What advice do you have for those who are looking to buy or for homeowners who are looking to renew a mortgage?
Yeah, I think that's a great question. Whether or not they increase the prime rate again at the next announcement, September 6th, I'm not sure. I'd say it's probably 50-50. But if you're taking out a mortgage today, or maybe you're in a variable and you're looking at what to do, our general recommendation is, to go with a shorter term fixed to maybe a 2 or 3 year fixed, or even depending on the discount on the variable's starting to look like it could be an option for some, believe it or not. But generally speaking, a shorter term fixed to ride out the storm for the next 12 to 24 months is the general recommendation.
Yeah, people may be a little bit gun shy of a variable rate mortgage at this point, though.
That's understandable. There's been a lot of trauma for the last 18 months.
Yeah, that's why you get a broker.
Absolutely.
James Harrison is a broker with Mortgages.ca.